Joining us today on Wall Street Silver is Michael Gayad. He is a portfolio manager at Toroso Investments and fund manager for the RoRo funds. How are you doing today, Michael?
I'm good, man. How are you?
We're doing pretty good. We thank you so much for joining us on Wall Street Silver. For taking your time and speaking to the community. We have a lot of questions to get right into. Lee, you want to kick it off?
Sure. So you're probably most famous in our community for the lumber to gold ratio. I know that's just one aspect of what you look at. You're brought into the markets, and it certainly has been a very interesting time the past few months. Why don't you tell us a little bit about the lumber to gold ratio, how you discovered it, how you use it, and how it's impacting the market right now, and then we can get into some more of the technicals that you look at.
Yeah, no, and I appreciate that. So since 2014, I've put out 5 different research studies that won 5 different awards, and each of them I presented on all over the country. And one of the research studies looks at lumber relative to gold as a leading indicator for the stock market. And of all the research studies I'm known for, it always gets the most curiosity because it's kind of a strange concept. Right? You always hear about copper to gold, you always hear about silver to gold, you always hear about oil, but nobody really talks about lumber except maybe this year, given how lumber has behaved. And the reason why it's an interesting relationship to track is because of the link to housing, right? So we know that housing is a leading indicator of the economy. Most people's wealth is in their homes. The average home has about 16,000 board feet of lumber. So it stands to reason that if housing is a leading indicator, well, then the long tail of construction due to housing makes lumber a leading indicator as well. So as lumber performs, there's all kinds of implications on what it suggests for growth, inflation, credit creation, so on and so forth. Gold, on the other hand, is more of a safe haven commodity, right? Meaning when you have these high risk periods in the stock market, gold for a moment in time tends to do fairly well. So you compare lumber to gold, it tells you a lot about risk. And when I used to present on the road on the findings of the research study, I used to always pause on this slide that looked at S&P 500 volatility when lumber is outperforming gold over the last 13 weeks versus when gold outperforms lumber. And the key takeaway was that when lumber is doing better than gold, usually you have lower stock market volatility going forward, risk on. And when gold outperforms lumber, you tend to have higher stock market volatility, which is risk off. And by the way, when I say risk on, risk off, I'm not talking about trend or direction in the market. I'm really talking about volatility dynamics changing. And it's funny because on Twitter, through my @LeeLagReport account, I have people that tweet at me saying, there's no relationship of lumber to the stock market. Meanwhile, they're saying that from their house, which was made with lumber. Right. So, and if you look at my pinned tweet, there's a number of examples that show that lumber to gold weakness there has historically preceded every single major tail event. Tail event meaning a big decline. 1987, lumber to gold warned in advance. 1990, lumber to gold warned in advance. Same deal with 2000, 2001, 2002, 2008, 2011, the 2018 fourth quarter correction, and then a week before the COVID crash started. In every single major situation, lumber to gold warned of a risk-off period to come. That's not to say every time lumber to gold is weak, you have a big decline. Mm-hmm. Rather that when you have a big decline, lumber to gold tends to already be weak. Just because it's raining doesn't mean you'll crash. Just because it's sunny doesn't mean you won't. This is a game of conditions and probabilities. And lumber to gold is one of those relationships that can tell you the weather.
So now I know you use the VIX in your analysis. I'm really dear on the VIX. I mean, I think it's such a great indicator to follow, especially the spikes up almost always show you when the bottom's coming. Do you ever look at the other way, the volatility spiking down? I had seen a sell signal on April 14th where the VIX kind of spiked down like it had before prior crashes. And that was just the top of the Bitcoin. I think it hit 60, whatever. Do you look the other way? I mean, and what do you think of the VIX action lately?
So it's a good question. So the latest paper that I won the 2020 Founders Award on looked at VIX levels as a tell for sector allocation. And what that study shows, and that's all available on ssrn.com or just Google my name and find that paper. But what that study shows is that historically when the VIX crosses below, let's call it 12 and a half or so, you're better off being in defensive sectors of the stock market, which is a little counterintuitive because you'd think if you're in a low volatility regime, you want more risk, right? Because the markets are going up and that's why volatility is low. And conversely, when you're in a high volatility environment where the VIX is, say, above 32, historically you want to go balls to the wall, aggressive cyclical sector allocations, right? Which is basically just a mean reversion strategy, right? In other words, you buy that which is aggressive after a VIX spike on the upside, which means everything's bombed out on the downside. And then when everything's very rosy and the VIX is very low, that's when you want to start playing defense because you don't know when you might have a VIX spike, but you know the odds are higher the more complacency there is.
I always thought of that as like a rubber band, like it can only stretch so far, and then it's got to go back the other way.
Yeah, and this is the thing about the research I put out there. So there's you either try to anticipate research volatility in VIX, you either try to anticipate it or you react off of it. Most people tend to react off of the VIX, right? You'll see a lot of hedge funds that will deleverage after a certain VIX level is hit. Mm-hmm. I tend to take more of the conditions-based approach, which is to say, rather than try to know exactly when the VIX spikes, what's the prelude to a VIX spike? And we know what that is, right? It's when there's a liquidity scare, when there's complacency. It's when, in the case of the research, I'm known for utilities are strong against the market, long duration treasuries are outperforming intermediate, and lumber to gold is weak, right? All these are sort of the precursors to that. And if you see that happening when the VIX is quite low, that's an even bigger tell, right? That you might have some kind of a mean reversion move where the VIX spikes further on the upside and you have a substantial decline in risk assets across the board.
Mm-hmm. So what are your thoughts on Bitcoin and crypto in general? They're kind of sold as a risk off asset, but they seem to be a risk on asset. What do you think of the current decline? Do you think it's bottomed? Do you think we're going lower? How do you think that interacts with the broader market?
So look, I fail to understand why the discussion around cryptocurrencies has to always be extreme, right? It's either all or none when it comes to Bitcoin and cryptos in general. First of all, it is not a risk-off asset, at least not yet. Pardon my language, I don't give a shit what anybody says. Okay, in the midst of the COVID crash, it crashed with equities. Absolutely. More often than not, Bitcoin, I would argue, and other cryptocurrencies are just simply a levered beta play, which kind of makes sense given the narrative, because if the argument is that this is about trying to hedge against the Fed's devaluation of the dollar because they keep printing more dollars, well, then that's the exact same reason why people buy stocks. So it's the same argument. It's just a more lever way of playing it. Now, the challenge, and I think this is what's really underappreciated when it comes to cryptocurrencies, you can trade them anywhere. It's a true free market, which means you can also lever it extremely highly outside of your country's own regulation. Okay, so if you were to Google 50x Bitcoin leverage, 100x Bitcoin leverage, or Dogecoin, or any of these other cryptocurrencies,
that's
insane.
You
may not be able to get in the U.S., but you'll get it in China, or you'll get it in other countries, right? So my point is that, look, one of the necessary preconditions to have a black swan, to have an extreme event, is leverage. Okay, overconfidence creates leverage, and there's an overconfidence in the cryptocurrency space, again, going back to the extreme point of it. But because there's no regulation around it, there's no regulation in terms of leverage around it. So it has these big ups and downs, which is why it's not really a risk-off play. It's very prone to margin calls because you can get margin from anywhere in the world to lever it up. And I think that's a really underappreciated aspect of it as a trading play. Now, if you're going to say, I'm going to hold on to it because I believe that Bitcoin is going to take over the world, that's a different story. But in that case, you just don't care about the volatility day to day. I hope for your sake, I don't mean you, but those that think that way, that they're right, because if you're going to believe the world is going to be taken over by Bitcoin and cryptocurrencies, that sounds like a pretty cataclysmic event, because the implications there are severe in terms of what it means for the state of society, the state of the wealth gap, the state of inflation. Mm-hmm. It's like all you got to do is peel the onion a little bit, and you start realizing that you'll probably start crying if you go to that logical extreme.
Well, the same could be said for the silver and the silver price, I would imagine, right?
Yeah, and look, okay, so let's talk about this. And obviously you guys are very focused on the silver space, and I tend to look at silver and gold as diversifiers, mm-hmm. right? Now, look, we all know that gold is historically perceived as a store of value. I've made the case many times, and I'm sure a lot of people are not going to like this, that gold is not a store of value. The last 10 years, gold has not kept up with inflation. Mm-hmm. It hasn't, okay? A store of value has to be defined properly. Store of value should be that which keeps up with one's own personal rate of inflation independent of the day, which means it has to be something which doesn't have high volatility, It means it has to be something that doesn't have tails in the distribution. A store of value has to be something which is truly stable. It cannot have big ups or big downs. Every asset class is like. So my argument would be that there's no such thing as a store of value. It's a term that people throw out that don't really know what it means. Mm-hmm. So what's the next best thing you can do? You have to diversify as appropriately as possible. And I think the problem is most people think diversification is buying 500 stocks or buying 5 stocks. To me, diversification is exposure to multiple unknown future paths, which means you want to have some exposure to equities. You want to have some exposure to silver. You want to have some exposure to gold. You want to have some exposure to Bitcoin. You want to have a mix of different things because you don't know which future is going to hit. Mm-hmm. So the best way to protect your wealth is to have exposure to as many of those unknown futures, right? And of course, you can wait, and the waiting is always the challenge in that, right? But the mindset is really important, I think, for people in terms of how to think about what is risk and what is safe.
Are you currently stacking physical silver or gold?
So I personally, as an entrepreneur, launching funds and running the RoRo ETF, all of my money, all of my cash flow is tied up in my funds. Now, having said that, somebody once said to me that diversification is a luxury for the rich, which is an interesting concept. The implication there is that if you want to get wealthy, you have to take a concentrated bet on something, which is also how you go broke, right? It works both ways, right? So when you're an entrepreneur, you've got to go all in into what you're doing. Mm-hmm. I mean, that's just the reality, which has its own risks. Mm-hmm. Now, if that works through the RoRo ETF, the mutual fund I run, all the other stuff I do at leadlagreport.com, if all this suddenly like a tree just sprouts seemingly out of nowhere, yeah, silver, gold, I'll be stacking them, and probably I'll be stacking Bitcoin too. That's at that point is when I could feel comfortable diversifying. Mm. But it's easy to say, do you own silver or gold to small business owners or to entrepreneurs? They might have it, and they might sound confident they have it, but they might own only 0.5% of their net worth because most of their net worth is in their businesses.
Yeah, that makes sense.
I think that's an important kind of distinction there.
So, do you have any thoughts on where silver's going price-wise and gold?
So, what I would say is, broadly speaking, I'm a believer in the secular commodity cycle, and I'm a believer in that because, aside from the fact that equities relative to commodities have it's such a big extreme, and I do believe cycles still exist. The reality is that, we keep looking at infrastructure spending in the U.S., but infrastructure spending is going to come everywhere. Mm-hmm. Okay, there's a global infrastructure problem, and no government seems to think debt matters, so you might as well just print money to build bridges and roads and all this stuff, right? As long as it's the right kind of infrastructure spending. All that's going to create sort of a broader movement towards commodities longer term, but within that, you're going to have these boom and bust cycles, right? Where short term it gets too extreme and then it breaks down and then it comes back and then it breaks down, all within sort of a broader upper channel, right? And I wouldn't be surprised at all to see silver benefit substantially from that, right? Because silver relative to gold, as you guys know, is much more of an industrial commodity as opposed to, gold as more of a diversifier in that sense. So I do think there's a secular case to be made there. Now, as far as arguments about structurally all the shorting and all the stuff that's gone on in the space, you guys know that much better than I would. I just talk more from a macro perspective. It makes sense that this is the other part of this, which I think is also interesting to think through, right? Is the wealth gap is only widening, not just in the U.S. but globally. It seems to me that the easiest way to at least and by the way, wealth gaps are natural in any society, right? It's very hard to really avoid that. So it's natural, but you also don't want it to get too extreme because then you have protests. Right? That's when you get Marxist elements kind of come into the system. So you've got to let the wealth gap widen to an extent to have free markets do what they do, but also not too wide. So how do you resolve the issue of it being too wide? Well, this is where infrastructure spending comes into play because the people who are going to be doing the bridges and the roads and the on the ground work are not going to be the Bezoses of the world, right, or the Musks of the world. Mm-hmm. It's going to be those that have lower net worth that. Yeah, so in other words, you can close the wealth gap a little bit by simply doing a reallocation of funding to those lower income parts of societies. So, and that's coming. That's my point, right? So, and that's all going to be bullish, I think, for the commodity space, and silver will be part of that.
How do you think equities will perform in such a scenario when they're spending so much on infrastructure?
Unclear, and I'll tell you why I'm saying it's unclear. The structure of markets has largely been for the last decade driven by growth sectors, which are things which are not as sensitive to infrastructure, primarily technology, right?
Sure.
And that's part of this why if you follow this kind of growth versus value style debate, right, that the growth style has substantially outperformed the value style for the last 10 years. Largely, that's a sector play, right? Value tilted parts of the marketplace tend to be heavily weighted in financials, tend to be heavily weighted in materials and energy as the top three sectors, whereas growth as a style tends to be more tech. So equities in the U.S., broad-based averages have done well because growth has done well because the S&P is tech-heavy. Emerging market equities, which are much more materials, commodity sensitive, the last 10 years have done nothing, right? So it's a question of which equities, right? Because if you're going to have this kind of broader infrastructure and secular play in commodities, I can unequivocally make a case that the biggest beneficiary will be emerging markets in that because they are usually the resource providers. Mm-hmm. U.S. markets probably would lag substantially under that scenario, which means that growth lags and value leads. But because growth is such a big portion of the U.S. averages, it probably means that U.S. markets are not going to do as well as one might think.
Yeah, Michael, can you talk about RoRo and how it started and how you even got the idea to start that?
That's great. Great question.
Yeah, no, I appreciate it. So I've been running a mutual fund called the ATAC Rotation Fund, which uses utilities and treasuries as the risk-on, risk-off trigger. And I've always wanted to broaden out the sort of product suite of the ATAC, a tactical fund family line. So basically, it's very simple. It's when lumber's outperforming gold, risk on, it goes 1.3x small caps and large cap growth. So risk on equities, right? Low volatility, that favors equities. Otherwise, if gold is outperforming lumber, it goes all in long duration treasuries. Now, the last 3-4 weeks, all public knowledge, all on atacfunds.com, the fund's been risk off in treasuries. Now, by the way, this is an important kind of thing to think through, and I always make this point. So we've had no decline yet as of this conversation. We've had no high volatility yet. Maybe we don't. That's okay, because if you're in treasuries as your expression of being long, or gold, I'd say less so silver, but gold would fit in that category. If you're wrong in your signal, meaning the market doesn't go down, but you're playing defense in those areas, you can still make money. Right? So ideally, when you think about an investment portfolio, you want to, and you're going to be tactical and trade, you want to have not just your signal be right, but you want to have an opportunity set that allows your signal to be wrong. Mm-hmm. Right? This is why a lot of these studies on market timing show that market timing doesn't work. The reason market timing doesn't work is because the alternative is always cash, which means you have to be spot on in your sell in terms of when the market declines. However, if you're in treasuries or other things which are not perfectly inversely correlated to equities, at least you have a chance to compound. So even though the fund positioning would suggest we're in a risk-off period and you haven't had a risk-off yet, it's still made money because treasury yields have been dropping. Mm-hmm. That's okay.
Do you anticipate something significant? I mean, we've had a bull market basically since 1980. Do you see something significant where we're going to have like a multi-decade bear market on the horizon, just given all the technicals you've been looking at?
Look, I think I'm a big fan of Nassim Taleb and Black Swan, anti-fragility, and ways of thinking about markets like that, and life too. What I would say is that when you have, and I think Taleb would agree with this, when you have a lot of leverage, the prevalence of black swans appearing is higher, right? In other words, these 1 in 1,000 year flooding events tend to occur more often than once in 1,000 years, the more leverage you have. Now, what's the response by the Federal Reserve for every single round of risk off? Liquefy.
Sure, yeah.
Means more leverage, right? So the leverage bomb keeps getting bigger and bigger, which means they have to keep on doing more and more every time there's another big decline, which means that you have more fragility in the system because you're so levered and you keep on relevering. So I don't know if it's a function of whether I would say that I believe that we would enter a period of sort of a long-term secular depression or deflationary spiral. What I would more argue is that you're going to have more of these extreme declines more frequently because of the current state of how much debt is in the system. Mm-hmm. And all that means is, and again, selfishly, I'm saying that, right? All that means is you're probably going to have more of these risk-on, risk-off environments, more periods where you're going to have people extraordinarily bullish on certain areas and then getting sorely disappointed when overnight it crashes.
Sure. No,
it's just going to be harder. I think my point is just going to be a harder future.
It's not a buy and hold future in your head.
I think it's a It's an interesting question because the joke about buy and hold is that nobody holds. I mean, that's just the way. It's like, I mean, that's probably why it works. Look, buy and hold has worked for the last century plus in the U.S. so far. It hasn't worked in Japan. Debatable if you can say it worked in Europe, right? So my only point in saying that is nobody knows what the future holds. For all we know, maybe the market's going nowhere for a long, long time. In which case, consider silver, consider gold, consider things which have themselves largely gone nowhere for a long, long time. Because at the end of the day, these cycles take a long time to play out.
Sure. That makes sense. Do you have anything you want to share with our audience before we say goodbye?
No, I appreciate it. Look, I mean, I hopefully this was at least worthwhile. Definitely check out the papers if anybody's curious, and follow me on Twitter. At Lead Lag Report. If you're curious about RoRo, risk on, risk off, feel free to reach out to me there. There's a lot of stuff that I try to do. Look, I always use this line on Twitter, right? There are no gurus. There are only cycles. There are only cycles, right? So if you have that mindset, what I would encourage everybody is just to try to be humble and realize that there's a time and place for every investment, every asset class. And true diversification means having exposure to all the areas where the cycle is not in your favor for when the cycle finally comes.
Makes a lot of sense. Great summary. Thank you so much for joining us today. We really appreciate it.
Yeah, guys, appreciate it.